Hi, everyone. So, the good news is that I'm only going to speak for 20 minutes. The bad news is that we've got to talk about the mad, bad, and opportunistic stock markets. So let's get to it. It's a mad world out there. Pollsters got it horribly wrong. Stock markets just shrugged it off. Went up despite Brexit, despite Trump, despite everything. And as for Mr. Trump, I'm not really sure what to think, to be honest. So, when we're thinking about markets, when we're thinking about how to make money, what on earth do we do? So, where do we start? What are people worried about? There's loads of things to be worried about in today's world. There's, you can see by the survey here, everyone's worried about Trump's trade policy, or Europe, or China, a multitude of issues. There's always something to be worried about, but there seems to be loads of them at the moment. And it's such a weird world out there. I mean, this chart, there's a lot of numbers, but in essence, real interest rates. Real interest rates are your nominal interest rate minus the rate of inflation. Real interest rates are negative in so many countries around the world. And as you can see by this chart, so many countries are still cutting interest rates, their central banks. It tells you it's a completely mad and strange world out there. There's no way this is prudent. And as Gervais said earlier, valuations are going up and up. This is kind of interesting stuff because it looks at how valuations are they're made up of various elements. There can be some fundamental stuff, corporate earnings, sort of good stuff. There can be things like inflation, which raises earnings or valuations. And then there's the pure sort of inflation of a valuation, a PE ratio or something like that. Now, take a look at this chart. The one you should be looking at recently is on the bottom right. And as you can see, over the last 7 or 8 years, valuation, that's the green bit, has been the major cause of why stock market valuations have gone up. It's been less to do with earnings or dividends or inflation. And as you can see, the only other time that green part was as big, or actually slightly bigger, was in the 1920s. The period ending 1929, when, of course, something just after that period, something interesting happened. So, it's a really strange world out there. Really strange. There's some good news, though. It's not all bad. There is some good news. Because if you take a look at some big global surveys, this is the manufacturing PMI, Purchasing Manager Index, looking at lots of important criteria for global companies, manufacturing companies, real companies making real tangible things. And if you look at this index, you look at the graphic and you see it's getting better. But what's really interesting for me, somebody who's looked at this stuff for a while, what's really fascinating is you look at all the sub-indices, and they're all getting better. So, to super summarize, we've got lots of weird stuff happening, lots of strange things occurring. Valuations going up, big negative real interest rates, big uncertainties, but somehow or other, central banks and governments and everybody else, they've managed to get us to a situation where things are getting a bit better. So on that basis, I'm done. Thanks very much for listening. Everything is awesome. Everything is clearly wonderful. It's a good film, actually. The trouble is, despite fund managers, which I used to be one, I guess I still am one to some extent, fund managers are really optimistic at the moment. So, you put all of that together, you put those last 2 slides together, everything's great. Fund managers are telling you everything's great. This is from a sort of a survey which looks at, it polls fund managers in the States. And as you can see, it's at its 97th percentile. Basically, in plain English, they're very optimistic based on historical precedents. So they're optimistic, everything's great, nothing to worry about. It's not really the real world, though, is it? Because there's loads of things to worry about. We could have a 20-minute presentation just on things to worry about. We've got rising inflation. We've got how the US are going to fund its bond market. We've got demographics. We've got all sorts of stuff. There's always things to be worried about. I could go on. We've got diplomacy. We've got trade balances. The chart on the right is actually really interesting. This is the change in US-bound flights after Mr. Trump's inauguration. And basically, the darker the colour, the bigger the increase, or the lighter, or the red ones, the less the increase. So if you go from Russia, lots more people are flying to the States, but not from anywhere else. Kind of interesting. So, diplomacy, trade balances, economic issues, there's lots of things to be worried about. Here's what I think, when you put it all together. Very loose central bank policy, high valuations, economic weirdness, uncertainty. It's a very mixed world out there. This on the left is from the National Federation of Independent Businesses. It's a sort of a US small business lobby group. It's really good survey stuff. My super summary would be the fact that there are as many red down arrows as green up arrows is all you need to know. It's a mixed world out there. The graphic on the right is from the Bank of England, who claim to know something about the UK economy. And what's really interesting about their stats is that they are sort of okay. It's just okay. It's not great, it's not terrible, it's okay. They may well be wrong about inflation or growth. Let's face it, they've revised the numbers enough times in the last year or so. But, it's okay. So, that's the mad and bad bit. That's the good news. How about the opportunistic bit? How opportunistically are we going to make money out of this stock market, out of this global economy? Because the really good news is, and I wouldn't be here if I didn't think this, is that there are plenty of things to be doing at this moment in time. In fact, you could say, I'm the most excited I've been for a long time. Here's the most important couple of slides in this presentation. If you remember nothing else, remember this. You may remember my use of the Lego film imagery, but, try and remember this. Because this is the really important stuff. And Gervais talked about it a little bit earlier in terms of active management, but I'm in sort of my typical geek type fashion. I got a couple of bits of maths for you at 9, whatever it is, on a Saturday evening. Let's start with the easy chart on the left. Passive funds have been very on vogue recently, very in. This chart shows the ratio of passive fund sales to active fund sales. And as you can see by the y-axis, passive funds are outselling active funds about 50 to 1. Basically, people love passive funds. And we all know why. Because basically they performed, they're cheap, and people understand them. They perform for a reason, and the reason is because with things like quantitative easing, with things like central bank stimulus and the like, stock markets have gone up in unison. Or to put it in a really kind of mathematical way, the intercorrelations of investments have been very high. And that's what you can see on the right. When intercorrelations are high, there's no point in trying to be clever in trying to pick stocks or stuff like that, because the macro exogenous factors, they predominate. They're the issues that you've got to worry about. But they're no longer doing that. The correlations are going down. That's why I'm excited. You can see this is a nice long chart. It's a couple of decades plus. And what you can see is that the correlations are going down now to levels we saw at the earlier part of this period. Now, this is really good news for active stock pickers. So, to summarize, despite uncertainty, fear, everything else, horrible stuff going on in the world, central banks doing crazy things, correlations are going down, which means active stock pickers are going to be rewarded. So if you're an investor, if you're an active fund manager, you should be very excited, very, very excited, particularly as most people are investing the wrong way at the moment in passive funds. That gets me really excited. However, and I say this as somebody who managed a couple of $1 billion in institutional funds, etc., up until 4 or 5 years ago, fund managers don't follow them. Because the thing is, as this evidence shows, there's no correlation between where fund managers put capital and what performs. And particularly in this weird, mixed-up world we live in today, that's certainly going to be true prospectively. Trust yourself in your own judgments. Now, this, I reckon, is the most important survey in the world today. And the reason why it's important is because it tells you how to make money, which is always quite nice. And what it is, it's the Bank of America Merrill Lynch Fund Management Survey. And many people use this because basically they poll a whole load of fund managers, including myself up to a few years ago, and ask them what they think about life, where they're overweight, where they're underweight, what they're worried about, what they're excited about, etc. I'm going to let you into a secret. Here's how you read this. Basically, anything that the fund managers are unexcited about, you buy. And anything they're excited about, you sell, broadly speaking. The reason for this is because the stock market, of course, is a wonderful discounting mechanism. We all know that. Anyone who's been involved in the stock market sees it. When it's on the front pages, everybody's excited about it and talking about it, don't buy it, because it's largely factored in. So, again, we could speak for the next 20 or 30 minutes about excitable investment themes and where to put your money and stuff like that, but just a few highlights from this. Let's start at the bottom, because I'm interested in buying low and selling high, ultimately. So at the bottom, you can see that the most out-of-favour assets or asset classes at this moment in time are the euro, the pound, and staples, consumer staples stocks. So, do I think the euro and the pound are cheap? Absolutely. Staple stocks, are they cheap? Absolutely. Now, Matt talked about Unilever earlier. He very modestly forgot to mention that on Friday they picked up a bid. Kind of interesting. Was the average fund manager highly exposed? No. They've been selling staples companies over the last few months in order to buy banks. Now, actually, that's quite a wise thing to do. Well, it was about 6 or 8 months ago. 6 or 8 months ago, we'd have had this presentation, we'd have seen banks at the bottom and staples companies at the top, because that's the way it is. Back in the end of June last year, if you'd have bought banks and sold staples, you'd have done rather well. But the time to reverse that trade was the turn of the year. And that's what this is telling you. And the fact that Unilever picked up a bid from Kraft on Friday fits in with this data. People weren't aggressively looking at that area, and that was wrong. At the top, what's expensive? US. US is expensive versus Europe. I mean, obviously, Mr. Trump's a big uncertainty, but from a fund management perspective, people perceive the States as safe. Now, individual US companies, of course, there are some good ones. But on average, they're expensive. Would I sell America and buy Europe? Absolutely. Very clear. Etc., etc. We could talk for 20, 30 minutes about this page. But suffice to say, what you should take from this is that active investment is going to work. Big time. What we've seen in the last 5 years was a function of that QE-induced environment, which perhaps was required given the depth of the global financial crisis of 2007 to 2009, but it warped stock markets, big time. Other things you should remember. This efficient frontier in investments, this happens, you should adhere to this over time. We've had a crazy last generation, I guess. Bonds have outperformed materially. Many bond markets have offered similar returns to equity markets, albeit at lower levels of risk, of course. But in absolute terms, bonds are poor value today, no doubt about that. Equities are all right value, opportunistic value. This efficient frontier, it works. And over the next generation, broadly speaking, you're rewarded with more volatility in equities, bonds are lower, lower return, lower vol. Absolutely, we go back to those sorts of norms. Of course, as an aside, it's kind of interesting that the average pension fund is now piled high with bonds because they're doing things like liability matching and stuff like that. But, that's, again, another story. Ultimately, though, the biggest message you should take from this conference and any other similar ones, what ShareTalk are trying to do, etc., is this is a world where you must always do your own research. It's an active world. It's a world of change. It's a world where experts probably are not going to be as correct as you think or they may perceive they are. It's a world where actually you as individuals can actually make money and can actually have successful portfolios. But it requires work. There are no shortcuts in investments. The old 90% perspiration, 10% inspiration metric, absolutely correct. Absolutely correct. The good news is, I think you're going to be rewarded prospectively. So do your own work. Primary research always is the best. There is no excuse nowadays. Company websites are fantastic. When I started in investments, they were terrible. Probably didn't even exist for half the companies. Today, they're brilliant. Webcasts, conference calls, presentation documents, etc. There is so much information out there, but you've got to dedicate the time to it. It's not easy. Investments is, as I say, a 90% perspiration game. The other aspect in our favour, generally, is that I'm optimistic about the world. This little picture here is kind of a wonderful one, because I thought, we've heard from some very innovative companies recently today. But, that massive pile of floppy disks, what is it, 128 megabytes of floppy disks in one hand, 132 gigabyte USB in the other. That's innovation. And the good news is that the world moves forward. It always does. The market mechanism may have its flaws, but it does encourage innovation and change because of the profit motive. And so long as that remains at the center and heart of everything, it's going to be all right. The trick is to find the right companies, of course. So, ultimately, I'm an optimist. In fact, the way I always end presentations like this is to say, the glass is half full. The glass is always half full. But in today's world, in an active investing world, for everyone in this room who likes investment, who wants to make investments, there are great things to be doing. The macro setup is in your favor. Active investments is coming back. It's just a question of working hard, finding the right investments, being sensible, and over time reaping the rewards. So thanks very much for listening. If you want to carry on the conversation, all my details are there. And I'd be delighted to answer any questions now, or I'll be hanging around a little bit after it's all finished. Thanks very much.